Thank you for joining us here at the Association of Indiana Counties. We are bringing to you some information regarding local income tax reform and the Municipal Unit Strategic Task Force guidance. These discussions will be in 3 parts as we work through to make them in more manageable portions to be received, because we know it's a lot of information. Also, we will be sharing some additional guidance and further information throughout the months of May and June. On May 18th, ahead of the Auditors Conference, there's a Budget and Finance 2 course where we're going to dive a little bit deeper into some of the lit reform and must guidance. June 12th, ahead of the County Council Association State Called Meeting, we're going to have a debt management course. This will also discuss how the debt management interplays with local income tax revenue and the bonds that are backed by lit sources. On June 13th, it's a Saturday, that is actually at the Indiana County Council Association meeting. We're going to have a couple different panels that discuss not only the lit reform, but how it could be applied within each of your counties. And these recordings, the 3 parts, will be released throughout May so that we can end May and into early June with the 6 different virtual district meetings. My name is Jamie Bolser, and I'm the Director of Government Affairs with the Association of Indiana Counties. Again, the first part that we're going to be diving into is the local income tax reform. We're going to go through this and talk about what is lit, where were we with the lit distributions, and due to the reform, where are we going? And then we're also going to cover what is must and some of the strategic practical discussions when looking at hosting must. Part 2 of the recording of the 3-part series, we're going to go and dive a little deeper into estimating the revenue neutral lit rates. We're going to look at what revenue would be generated from non-municipal to municipal homeowners and what lit rate, whether it's applied just at the municipal level or at the county-wide level. The third part is where AIC has been in partnership with Policy Analytics to develop an interactive portal for county and municipal revenue projections. We are also developing a homeowner tax incident analysis. So basically, what revenue would be generated at what rate, whether it be for individual cities and towns or for the county as a unit of government. And then the second part, the homeowner incident, would be based off of those decisions, what impact would that have on our local homeowners and taxpayers? First part is going to be the local income tax reform. So with that, what is local income tax? You often hear it referred to as LIT, which is the acronym. It is a county imposed or a local imposed tax that is applied to taxpayers' taxable income. It is also a source of revenue for many other local units of government, whether it be cities and towns, in some cases school corporations, townships, fire departments. But the units of government are currently in 2026, all the collective units of government are set to receive $4.1 billion in 2026 of lit revenue. That is up from $3.982 from the prior year in 2025. So what is a local income tax rate? A county's income tax rate represents the total of specific types of lit, which each have their own individual rate. The rate is applied to each taxpayer's wages over the course of the year, and that's for all taxpayers in the county. Withholdings are often taken out of each paycheck or maybe be paid quarterly by self-employed taxpayers. If the lit rate is the total of the specific types of lit, what are the types of lit rates that comprise the overall total lit rate? Well, those are broken down into certified shares, public safety, economic development, correctional or rehabilitation facilities, emergency medical service, often referred to as EMS, judicial, acute care hospitals, which just became recently effective July 1st of 2024, property tax relief, you also hear that referred to as PTR, special purpose rate, and in some counties, a levy freeze rate. Who pays the local income tax? Income tax rates are adopted at the county level and are paid by the residents of that county. All of the residents that have taxable income pay the local income tax rate. The county of residence and the county of principal business or employment of an individual are determined on January 1 of the calendar year in which the individual's taxable year begins. If a person resides in an Indiana county on January 1 or resides out of state on January 1, but has his or her principal place of work or business in an Indiana county as of that January 1 date, he or she is subject to a county tax at the rate corresponding to that Indiana county. Well, who plays a role in the collection, calculation, distribution, receipt, and auditing of LIT? As you can see from the slide, it is a very progressive computation of multiple different county offices and state offices. The first is the county adopting body. The county adopting body is either the county fiscal body or the local income tax council. If the county was a former Cadgett county, the county council is the adopting body. Currently, there's 58 former Cadgett counties throughout the state. If the county was a former Coet county, then the adopting body is that local income tax council or the LIT council. What that means is for a LIT council, it's based and driven off of the number of votes by the population. So it could occur where a city or town, one single city or town that has the majority of the population in a county, that city or town could control the individual vote for that LIT council, which then would have that rate be applied to all county residents, even those not within that controlling city or town. The next segment is the Department of Revenue. The DOR is responsible for informing the taxpayers and employers of the newest county total LIT rate and the process for paying the income tax. DOR also collects the LIT revenue for the state. The State Budget Agency, often referred to as SBA, is responsible for reconciling and certifying the total amount of LIT revenue by county and by LIT type. The totals are posted online, then distributed to the Comptroller's Office at the state and to the Department of Local Government and Finance, or DLGF. SBA will post LIT estimates between August and October. By December, SBA will certify the ensuing year's LIT amounts. Generally speaking, the LIT dollars being distributed in 2026 are based off the processed collections from July 1 of 2024 through June 30th of 2025. The DLGF then gets the baton in this long relay race and calculates and distributes the unit level reports. So SBA compiles all of the LIT revenue per county and per LIT rate, hands that off to the DLGF, and they do the in-depth complex calculation that shows the unit level, whether it be township, the fire districts, territories, county, municipalities. They do that for both calendar year certified totals and the supplemental distributions that follow later in May. The Comptroller's Office is responsible for making monthly distributions to the county auditor's offices for all LIT revenue, with the exception of the property tax replacement, or PTR. PTR LIT is distributed to counties in time for the spring and fall property tax settlement. The Comptroller's Office also distributes those supplemental distributions to the qualifying counties in May. The county auditor reconciles the monthly LIT that's received from the Comptroller's Office with and utilizing the DLGF's unit level reports. The auditors also submit the ordinances for the LIT changes to the state. the local units of government receipt that monthly lit distribution that they receive from the auditor and reconcile the amounts with those state reports. And then that last leg, and it's after the fact, is the State Board of Accounts. They come in and they are responsible for the development of the chart of accounts that is used by all the unit types and audits units to determine that the lit distributions were handled in a manner consistent with statute and their accounting principles. This slide here shows you the lit configuration. In green, you can see the overall expenditure rate. The total expenditure rate for all of these categories cannot exceed 2.5% on the current lit mechanism or the current lit structure, except for Marion County, which has an expenditure rate maximum capacity of 2.75%. So the expenditure rate is made up of certified shares. This does include the levy freeze amounts, economic development, public safety, which includes PSAP, any fire department, volunteer fire department, and EMS, the correctional rehabilitation facilities, emergency medical services, or EMS, judicial, or acute care hospitals. In former Cadgett counties, the first 0.25% of this certified share, the top category within that expenditure rate, the first 0.25% is distributed to all local units, including schools. The rest is then distributed to all units except for schools. So Cadgett counties, there's 58. So there's 58 counties in which all the schools are receiving 0.25% of that first certified share distribution amount. The public safety rate, it does include, as I mentioned, PSAP, fire department, volunteer fire department, and EMS when applicable. The property tax relief is a separate category from the expenditure rate. It has a separate capacity amount of 1.25%. And then you have 21 counties that have a special purpose rate that has been approved by the General Assembly. This is a makeup of the current local income tax overview. Senate Enrolled Act 1 from the 2025 session changed or began the reform. This was originally set to expire in 2027. However, House Enrolled Act 1210 from the 2026 session pushed that expiration date back just 1 year. So this now expires in 2028. You can again see the individual buckets of that expenditure rate. So the certified share, the public safety, economic development. Uniquely, the correctional facility has a maximum capacity within that individual bucket, within that expenditure rate of 0.2%. EMS has a capacity of 0.2 for that individual type. Judicial, again, 0.2 as an individual maximum capacity. And then acute care hospital has a maximum of 0.1. Collectively, those again make up the total expenditure rate, which cannot exceed 2.5% unless you're in Marion County. The property tax relief has an individual capacity rate, again, of 1.25%, and then you have that special purpose lit. The current lit is attached to all of the adjusted gross income, or AGI, of the entire county. And then you can see, based off of the chart, the individual adopters of that rate adoption. The certified shares, public safety, economic development, will be based off if you were a former Cadgett or COIT. Again, Cadgett counties, those are being adopted by your county fiscal body or the county council. And then the former COIT is being adopted by those lit councils. Lit funds are allocated to all local units based on property tax levies. So the public safety lit is distributed based on being a former Cadgett or COIT county. In former Cadgett counties, public safety is distributed to counties, cities, and towns proportionately using the current year certified property tax levy. There are adjustments for debt or prior year certified shares, fire territories, and welfare allocations. In former COIT counties, public safety is distributed to counties, cities, and towns proportionately, just using the certified property tax levy method. So again, public safety dollars is not distributed to all local units, just the ones that are providing those public safety measures, which again are your counties and cities and towns. Again, it's being distributed proportionately overall based off of that property tax levy. If a county has PSAP, which is a public safety access point, that allocation is an off-the-top allocation to just counties. Counties may reduce the public safety distribution to account for fire departments, volunteer fire departments, EMS, fire territories, and townships. Economic development, LIT, is distributed to counties, cities, and towns. Counties may opt to have EDIT distributed based on certified property tax levy or based on population. Correctional rehab, LIT, is distributed and used by the county only. Property tax relief buys down the property tax bill of taxpayers within a property type that are chosen. So for example, some counties just choose to buy down that overall property tax bill to just homeowners or homesteaders. Some allow it to be applicable to all property types, whether you're a 1% for homeowners, 2% for all other residential, or 3% to include your businesses and industrial and personal property. Special purpose lit is provided to 21 counties that have special statute enacted under state statute. Under the current lit structure, there is a perverse incentive to increase your property tax levy, which would then ultimately result in a higher local income tax distribution. Non-municipal taxpayers currently under this system are subsidizing cities and towns' distribution because of how those dollars are distributed. This slide shows you the certified local income tax rates that are currently shown on an aggregated statewide basis. You can see all 92 counties have an overall total expenditure rate on average of 1.62%. If your county is shaded darker, you just have a higher overall rate. And the property tax relief rate, you can see 58 counties have that adopted currently statewide. The new local income tax structure becomes effective in 2029, so those key crucial decisions will need to be made and adopted in 2028 so that they can become effective in 2029. So moving away from the individualized buckets that make up that expenditure rate total, they are now bucketed by county service rate to not exceed 1.2%. That rate adopted would be by the county council, and the tax base would be for the AGI of the entire county. Then there's a fire protection and EMS service rate not to exceed 0.4%. Again, the county council is the adopting body, and that rate is applied to the AGI of the entire county. There's a non-municipal tax rate for townships, libraries, that is again adopted by the county council upon petition from those non-municipal units. That cap is at 0.2% and again utilizing the AGI of the entire county. The total of those three, while it totals 1.8%, cannot exceed 1.7%. Municipalities that are less than 3,500 a population have a 1.2% rate cap. That is going to be adopted by the county council upon request from those small municipalities. That AGI will be the AGI of the entire county, less any income within a municipality that can adopt their own lit rate, which would be those municipalities over 3,500. So the key change here within House Enrolled Act 1210 from this last session, municipalities can opt in to be treated like a small municipality if they want to access the AGI of the entire county. Now, what would occur is, again, that current structure, it would be taxing the non-municipal area residents and attaching that rate and distribution to those municipalities. However, they also have the option to adopt their own municipal rate, not to exceed 1.2. That option would be adopted by the city or town council. And again, that cannot exceed 1.2. The difference is on that tax base. That tax base is for municipal taxpayers only. Again, this just shows the breakdown of the overall county service rate, 1.2, fire EMS, 0.4, non-municipal rate of 0.2, which cannot total more than 1.7. Then you stack very similarly, like property taxes, the municipal rate, whether it be a small or a large municipality, cannot exceed 1.2 either. So the total tax rate for all local units of government cannot exceed for a taxpayer of 2.9%. Now let's get into more of House Enrolled Act 1210. From the 2026 session, a municipal unit strategic task force with the acronym of MUST was created. This provides counties as a local unit the option where they may, prior to October 1 of 2026, convene MUST. One county council representative, in addition to the fiscal officers of each city and town, will comprise MUST. The purpose is to establish a local income tax distribution agreement related to that overall 2.9% capacity. If a unanimous agreement is reached, they are to submit to the DLGF a report that shows that configuration and shows it's a unanimous decision so that the DLGF can submit that to the Legislative Council by December 1st of 2026. AIC is recommending a very cautious and deliberate approach, particularly with timing. AIC, again, is in partnership with Policy Analytics. We are developing data resources to support these very important lit discussions and the distribution amounts. We are building an interactive portal for county and municipal revenue projections and a homeowner tax incident analysis that will show you the impact for your taxpayers, whether they are non-municipal taxpayers or municipal taxpayers. It'll show you the direct result to them as a result of these important decisions that you have ahead of you. The third part in this series will dive in and show you how to use those interactive portals. Additional details and guidance will be provided. Again, Budget and Finance 2 course on May 18th. We're going to dive a little deeper. Virtual district meetings were going to be held in late May and early June after you've received each of the 3 of these pre-recorded videos with some details to absorb at your own speed and on your own time. And then we're going to also have at the State Board of Accounts called County Council Association meeting. We'll have some discussion on that June 12th debt management course, but then go in heavier on the June 13th meeting, which is on a Saturday. The data will include updated financial and unit level information. AIC certainly recommends to wait to convene MUST until all of these additional trainings and updated financial unit level data is provided to each of you. The DLGF historically releases its legislative guidance and interpretation of new law in June of every year. So we don't have the DLGF's interpretation of House Enrolled Act 1210 yet. That again will be released historically, would say closer into the mid-June month. We do not want to overstep their important interpretation of all statutes that will impact the decisions that each of you have to make. Also, the Department of Revenue is collecting a new data point this year with those income tax returns that were just filed as of April 15th. The new data set point is the physical address of where that income is located within your county. That will show a very important, crucial piece, which is where does that income reside within a municipality or within a town or non-municipal area. The DLGF, in collaboration with the state budget agency, releases the 2027 lit estimates on or before August 16th of each year. So waiting closer to that period, you will have the most updated information available to you. There is also a new requirement in House Enrolled Act 1210 from this last session, and that is by August 1st, the fiscal officer for each unit of government must provide the DLGF with the total amount of debt that is payable utilizing lit revenue. This is important information that has not been previously collected. So this is crucial information to know how much debt, how much of a rate is needed to make sure that those debt payments can be paid. Again, that data has not been previously collected, and we will have that in and available by August 1st of this year. If cities and towns are currently reaching out to begin scheduling the meetings to avoid any scheduling conflicts, we believe the best time to convene the MUST is later in the summer, early fall, after some of those crucial dates have passed, so we can ensure that we have the most current data to make and drive our data-driven decisions. This will provide enough time to receive, again, the most up-to-date information ahead of that October 1st deadline. And we will discuss that more in depth as we move forward in this three-part series and again at those other dates that I mentioned. I'm not going to spend a lot of time on the next couple slides. However, we have provided counsel and auditors some key crucial financial and operational information that could be very substantial and related to making the most informed data-driven decision. Those are listed throughout the next slides, as well as some additional data that could show the why behind some of those data requests. This slide here I will pause to show. This was an estimate of property tax revenue implications year over year. And you can see at the bottom, those property tax levies have increased at the lowest rate for counties, which again, keep in mind, that does have a direct impact on those lit distributions moving forward. So the higher the property tax levy increases, the more lit revenue that will also be received, which is one of those key components of the lit reform. These slides will be available to you with the recording so that you can pause and take the time to go through those key financial data requests that was provided. Lastly, these important decisions, you have to also keep in mind where the General Assembly is headed and where they have said that they are intended to head with property taxes moving forward. Property taxes are moving to a rate-based rather than moving away from a levy-based system. Once we move to a rate-based, that certified tax rate will be capped at 3%, which will certainly limit any available revenue growth to counties and other units moving forward, which is what makes and drives some of these lit decisions to be very crucial for future funding and to be able to adequately plan strategically for your budget, whether it's a 5-year plan or a 10-year plan. Again, when it comes to income taxes, counties and cities and towns have several key income tax decisions ahead of them. The local income tax may replace property tax reductions, but from a narrower tax base. For the first time, we may see different income tax rates within counties, and data is key to making these informed lit decisions. As far as the must committee, each county may, again prior to October 1st, convene a must meeting. Again, we believe strategic timing is crucial just to ensure that you have the best, most updated data. If must establishes an agreement, the county shall send that agreement to the DLGF. And again, we just ask you to again consider the benefits of the data-driven decision-making process, which again is key and crucial. And we believe it's why it's in the county council's laps, because historically it is shown county councils do make sure to utilize this data when making these key crucial decisions. So that completes our first of the three-part segment. Please join us for part 2, where we're going to dive in a little bit more to estimating revenue neutral lit rates.